Good afternoon. My name's Roy Saunders. I created the IBSA in 2014 as the only multi-jurisdictional and multidisciplinary association for entrepreneurs and their professional advisors. It's a unique platform for younger professionals to develop their knowledge of disciplines other than their own speciality, as well as networking with other professionals in over 35 countries where we have members. The members are lawyers, bankers, accountants, entrepreneurs themselves, IP specialists, growth funding specialists, corporate service providers, and my own speciality, international tax advisor. As such, I created my own international tax practice back in 1972, when in fact international tax wasn't really recognized as an imperative in an emerging global economy. I first met our presenter today, Dmitry Zapol, at an international tax course that I taught at London University in 2009, following which he joined me at IFS and is now running the company as I have spent time developing the IBSA. Dmitry is both a committee member and my enthusiastic deputy, and will be talking to us today about the UK tax system, particularly as it relates to residents and non-domiciled individuals. So without further ado, Dmitry, welcome. Delighted to have you with us today. And maybe you can start off by describing the UK's tax system.
Hello, Roy, and thank you for such a wonderful introduction. This webinar is aimed at people who are looking to relocate to the UK, who have never lived in the UK before. The key feature of UK tax system, I suppose, are quite significantly differentiated tax rates. The top rate of income tax is 45%. You pay that in respect of dividends, salary, foreign source interest, and coupon payments. Whereas the top rate of capital gains tax is 20%. You pay this in respect of disposals of assets such as shares, real estate, etc. There are a few other rates, such as 28% tax rate in respect of disposal of residential real estate, but we won't be focusing on that. So you see that the disparity is quite large. And of course, it makes sense to structure your tax affairs in a way that would allow you to pay the least amount of tax possible. The second feature of UK tax regime is the so-called taxation of non-domiciled individuals. I will be touching upon the concepts of residence and domicile in a few minutes during the course of the webinar. However, one thing that you should know, that if you are broadly from outside the UK and you have just moved in this country and you are receiving income from sources outside the UK, as long as you do not bring your income in the country, you do not need to pay tax on it. We call this remittance basis of tax, which is also colloquially known as res non-dom taxation.
Well, res non-dom, I'm not quite sure how long we're going to have res non-dom. I believe, certainly the Labour Party have said that they're going to abolish non-domicile, but I think without a doubt the Conservatives are going to bring something in before the next election, which is going to be very, very similar to our current laws on non-domicile but resident individuals, basically offering an incentive to people who are outside of the UK to come here for a limited period of time. And that replicates a lot of the laws around the world, where Italy, Spain, Portugal, Israel, many countries offer that sort of temporary non-residence. So I think we're going to get to that. But maybe you can tell us about the remittance basis of taxation, because that's going to apply whether we have the non-domicile concept or whether we just have the non-resident or the temporary resident concept.
Before I touch upon the non-domicile taxation, let me first establish a few key concepts which are instrumental to understanding UK tax system. The first concept is tax residence. Why is it important? Because if you are tax resident, you're subject to tax on your income from sources in the UK and also potentially on income from outside the UK that you bring in the UK if you remit it here. The second concept is, of course, domicile, and I will be touching upon it a bit later. So first and foremost, we have to establish residence by relevance to a UK tax year. Unlike in many other countries, UK tax year runs from 6th of April until the 5th of April of the following calendar year. This means that there's often an overlap when, say, 2 consecutive, say, Spanish tax years cover one UK tax year. This is relevant when we are applying for double tax relief, and this allows us to obtain, well, certain exemptions from paying tax in the UK. Once we established the UK tax year, we need to understand how we are establishing residence by reference to such tax year. We need to understand how many days a person spends in the UK. The concept of days spent in the UK is quite different from that used for immigration purposes. For the purposes of taxation, a day spent in the UK is any midnight that you spend here. For ease of reference, it's easier to count number of nights you're staying in a hotel. So, for example, if you arrive in the UK on Saturday afternoon and you leave the UK by 11 p.m. Sunday, you will only spend 1 day in the UK for the purposes of determining your residence. The reason I'm describing this in such detail is because often residence determination can hinge upon a single day spent in the country. Therefore, it is of paramount importance to keep close track of your presence here. Now, it is a common misconception that if you spend fewer than 183 days in the UK per tax year, you will not be UK tax resident. Of course, this may occur in certain circumstances. However, the reality is way more complex. Broadly, the cutoff periods which we need to consider are spending fewer than 91 days in the UK, spending fewer than 121 days in the UK, or spending fewer than 183 days in the UK. Depending on a set of personal circumstances, you can be considered UK resident even if you spend as few as 46 days in the UK. We're often asked, what is the center of vital interest determination in the UK? Because this is something that we would use in Spain, in France, sometimes in Germany or in Switzerland. Until 2013, the concept of center of vital interests was something very ethereal and very hard to describe. Thankfully, since then, we have had the so-called statutory residence test. The statutory residence test envisages a set of criteria and tests that we have to satisfy or fail in order to be considered UK tax resident. Issues that we consider include whether you are employed on a full-time basis in the UK or overseas, if you have a permanent home in the UK and you don't have a permanent home overseas, if your family is tax resident here, if you have accommodation in the UK, or if your children are tax resident in the UK. Things like having a company here, or having a bank account, or being registered with a doctor are largely irrelevant in determining your tax residence. My advice to you would be the following. If you are looking to spend fewer than 91 days in the UK per tax year, there's very rarely cause for concern. However, if your presence here exceeds 91 days, and you're renting accommodation here, and you are doing certain work here, then you definitely should talk to us to help us establish your tax residence. One thing I need to point your attention to is that when we are talking about working in the UK, because working in the UK may influence your residence determination, this involves not working just for a UK company, but being seconded here or being a self-employed person or a director of a foreign business. In other words, what matters is your physical working presence in the UK. So in respect of every year, we need to consider whether you are resident or not. And one final thing to consider, once you have been considered resident in 1 year, in the following year, it is much harder to become non-UK resident.
So clearly the statutory residence test has helped to some extent in that it's cleared a vague notion of what's your standard place of residence. For people who are not resident in the UK, they wouldn't be taxed on foreign income. Of course not. They would only be taxed on UK source income. What about then the people that I was alluding to earlier, the people who come to the UK on a temporary basis, let's call it, whether it's domicile, non-domicile, and so on? Perhaps you can lead us through that concept of the remittance basis of taxation and domicile itself.
Right. To give a bit of background, the concept of taxation of non-domiciled individuals goes back to 100 years ago, perhaps you can correct me there, when the Great Britain had foreign colonies. And in order to encourage foreign plantations owners to come to the UK, they were told that as long as you are not originally from the UK, as long as your parents are from the overseas, and you have your foreign sources of income, to encourage you to come to the mainland, we will allow you not to pay tax on income that you earn from your foreign sugar cane plantations. Whereas anything that you bring in the UK will be subject to tax. And of course, anything that you earn in the UK will be taxed here. So this concept has remained unchanged pretty much for the last 150 to 100 years. So the remittance basis of tax, remittance being the bringing of money in the UK, hinges upon the concept of domicile. It can take us hours to consider this in detail. Suffice it to say that domicile is a common law concept that determines your particular affiliation with a particular country. For UK tax purposes, everyone has their domiciled origin, which typically passes from father to their children. Most of our clients who come from the UK of non-UK parents have their foreign domiciles of origin. Of course, perhaps if your British father moved to France 50 years ago and you were born there, then the question needs to be asked whether you're truly British or French domiciled, but we'll leave it until the next webinar. Now, there's also a concept of domicile of choice. You acquire British domicile of choice, or to that effect, any other domicile of choice, if you express a desire to live in a country permanently or indefinitely. If you become British domicile by choice, then of course the remittance basis of tax is unavailable. However, in reality, you must really prove that you've ceased all links with foreign countries and you want to live and die in the UK. Therefore, UK domicile of choice, British domicile of choice rarely arises. One final thing to consider is what we call a deemed domicile. You are deemed UK domiciled if you have been living here continuously for 15 tax years. For most people coming to the UK for 5, 6, 7 years, this concept is irrelevant. Now, once we have established the concept of domicile, we need to talk a bit about the actual remittance basis of tax. So the first concept to consider is what are foreign source income and capital gains, which are not taxed in the UK unless they're brought here. Quite often, it's quite easy to determine. If we're talking about dividends, dividends are foreign source if they're received from a company resident outside the UK. If we're talking about foreign interest, it is interest paid from a foreign debtor. If we're talking about foreign capital gain, typically it is a gain arising on the disposal of a foreign situated asset, such as sale of a foreign registered company or sale of a foreign property. However, sometimes it is quite hard to determine whether particular income is UK source or foreign source. For example, if a person is receiving employment income or sole trader income derived from their personal services, it is normally derived from the place where this person is performing their duties. Therefore, anyone who is coming to the UK and who is paid by a foreign employer and who is deriving money from foreign sources, but nevertheless who is physically working in the UK, their income will be considered arising in the UK. There are complex rules which determine location of sources of income and capital gains, and each case should be considered individually. Now that we have established the basic principles of sources of income and location of gains, we have to consider what constitutes a remittance. Income or capital gain is remitted if it is used or received for the benefit of a person who has basically earned it. We're calling such people relevant persons, but for now we will avoid the jargon. The typical examples of remittance include such as if you receive dividends from a foreign company and such dividends are paid in your UK bank account, such dividends are considered remitted in the UK. If you credit your dividends to your Swiss bank account, but then use a bank card in the UK, which is linked to such bank account, the amount will be considered remitted. If you take out a loan from a foreign bank account to purchase a property in the UK, and you service the principal or the interest with your foreign source dividends, such dividends will be considered remitted.
And what about credit card, use of credit card in the UK?
It's a very good point. Until you are paying off the balance of the credit card, there's no remittance. But even if the card issuer is located overseas, but you're settling the debt towards payment of a credit card with your foreign unremitted income, it will be instantaneously considered remitted. One example which I like to give, which explains how complex such rules are, is the following. If a person is married, then if their wife or if their minor child spends any of their foreign income in the UK, the husband will be considered remitted their income. So, for example, if the wife goes to a restaurant and pays the bill, the husband will have to pay tax on the amount of money which the wife spent in the UK. If they pay for their child's school in the UK, the husband will still have to pay tax on such amount. Now, if they ever get divorced, all of a sudden, there's no issue with the wife bringing money in the UK because she is no longer connected with the husband and he will not be subject to tax. But if under the separation agreement, the wife pays for their minor child's education in the UK, even without the husband's knowledge, he will be subject to tax in the UK. He must report it to the revenue. The question.
That sounds quite a bit of fun. And with 50% divorce rate in the UK, that's probably going to happen quite a lot. What about other money that you're bringing into the UK? Can you actually bring capital into the UK? And what sort of capital can you bring into the UK?
You've used the right word, capital, except that we describe it as clean capital. Clean capital is anything which is not subject to tax in the UK. You will not find this word in tax acts. Rather, it describes anything which is not subject to tax in the UK, as I've just said. Gifts that you receive are not subject to tax in the UK and constitute clean capital. If you inherit something and bring it in the UK, it's not subject to tax. If you sell something without making profit, such as foreign property or foreign shares, then this constitutes clean capital. But most often, clean capital comprises income and capital gains which are earned by the person before they become UK tax resident. This is why it's very important to determine the exact date when the person becomes UK resident. If someone becomes UK tax resident on 6th of April of a particular year, their clean capital must be collected by the 5th of April. How this can be done? Well, ideally, by 5th of April, you must receive dividends in a bank account, you must pay yourself salary in a bank account, you should sell your assets and collect gains in a bank account. As long as you have a bank extract which shows that right before you became UK resident, you had a certain sum of money in your bank account, this will be a sufficient proof that you have clean capital. A question that we're often asked is whether we need to bring clean capital in the UK. And the answer is no. You can keep it in the UK or outside the UK. It's all up to you.
I might have interrupted you when you were talking about deemed domicile. Did you mention the 15-year period that people can come here and not be deemed domiciled? I can't remember whether you said that. And also, you can mention the 7-year period as well.
That's right. I'm oversimplifying matters a bit. The rules say that if in any 20-year period you have been UK tax resident for 15 years, on the 16th year of resident, you will become deemed UK domiciled, and you will not be able to use the remittance basis of tax. We call it the 15 out of 20 rule. And in principle, it is possible to leave the UK for a couple of years and come back and restart your remittance basis clock. When you mention the 7 out of 9 rules, it means that for the first 7 tax years of your life in the UK, you can use the remittance basis without any financial penalties. However, starting from the 8th year of your continuous UK residence, in order to not have to pay tax on foreign unremitted income, you must pay £30,000 for such privilege. On the 13th year, £30,000 goes up to £60,000. The maths here is very simple. Every year, starting from the 8th year, you should calculate how much income you're earning abroad and how much tax you would pay on it if it was brought in the UK. If the amount of tax on such income would be less than £30,000, then of course it's not worth claiming remittance basis and you should declare your worldwide income. But of course, if you're earning anything above £200,000, then of course tax on such amount will be significantly higher than £30,000, and it's worth paying this amount.
When I mentioned before earlier on about the Labour Party abolishing the non-domicile rules and perhaps the Conservative Party preempting that by bringing in some sort of legislation before the next election, the 7 out of 9 year rule, I believe, will be the new type of rule, which isn't dependent upon domicile as such, because as you mentioned, the domicile notion is such an outmoded notion. But the 7 out of 9 year rule might be applicable for people coming into the UK on a temporary residence basis and not paying tax other than on a remittance basis of taxation. So that's interesting about the clean capital. Would you like to mention business investment relief? Because I think that was something that is quite relevant for a lot of our clients.
Yes, of course, Roy. When you have your clean capital, you want to keep it, to use it for your own life expenses, to pay for life in the UK, to pay for rent, pay for your children's education, etc. As we know, of course, clean capital is limited by the amounts that you will have created before you are UK resident, and therefore it's finite. So what happens if you want to finance UK business? Because if you bring anything other than clean capital in the UK to give a loan to a company based in the UK, or perhaps to subscribe to such company's shares, unless such amount is clean capital, you will pay tax on remitted income. In other words, before the company benefits from your loan or share subscription, you will have to pay tax on the remitted income or capital gains. To counter that, they've introduced a relief called business investment relief. In essence, the relief allows you to lend funds or to subscribe for shares of a UK trading company. And as long as the company is using such funds and you are not benefiting from such funds, you will not be considered remitted them. To give you an example, your friend might invite you to finance their corner shop in the UK. Corner shop is a corner shop belonging to a UK company, which will be perfectly considered a trading activity. You, as a shareholder or as a creditor of such company, would lend it directly, would subscribe for A-class or B-class shares. And as long as the corner shop company is using such cash to promote its trade, you will not be paying any tax on it. Now, of course, if you're receiving interest or dividends from such company, you would pay tax on them because it would be considered your UK source income. But as long as when the time comes to repay the loan or to buy back your shares, you take out the proceeds outside of the UK, you will not pay tax on the initially invested amount. And by the way, I should add that you can also invest into property companies and not only finance companies, you can finance your own company. But you should be aware of one important limitation. You see, the aim of the relief is to promote investment in companies. There's no way that you should be able to benefit from your own money. So what typically happens is that if you finance a company, then you are using a company, you're using a company's car, or you're living in accommodation belonging to such company. You must be very careful and declare such benefit in kind in your return and pay tax on it, because otherwise the whole amount of the investment might be considered connected with the benefit you're receiving, and therefore the relief will be unavailable. What's good is that you can obtain a ruling, a non-statutory clearance before you're making the investment within 30 days, and it's quite easy to do.
Okay. Now, I know that I've mentioned the Labour Party a few times may abolish the non-domicile rules. We know domicile, yeah, only if you are non-domiciled would you be able to claim the remittance basis of taxation. But if you're non-domiciled, you should only be paying inheritance tax on assets situated in the UK. Not quite sure what's going to happen if they do change the domicile rules, and whether or not a temporary resident would not be paying tax on foreign assets. But at the moment, as I see it, if you abolish the non-domicile rules, then anybody that's resident in the UK would suddenly find themselves paying inheritance tax on foreign assets as well as on UK assets. Any comment on that?
I don't have an answer to that, but why don't I tell you a bit about the schema of UK's inheritance tax?
Yeah.
At the moment, if you are domiciled in the UK, then you're subject to inheritance tax on your worldwide assets. In essence, this means that if such person dies, anything that they own in the UK and outside the UK will be valued, added together, and subject to small exemptions, will be subject to 40% tax that must be paid out of your estate. Of course, if your estate does not have enough free cash, then the executor must sell certain assets to finance the payment of tax liability, or your heirs need to find some cash. Now, if you are domiciled outside the UK, then you're only risking liability in respect of assets situated in the UK. But anything that you own outside the UK will be outside the scope of tax. So here again, we have to understand what constitutes assets located in the UK. Of course, it's real estate located in the UK, cash, which is kept in UK bank accounts, and companies registered in the UK. For this reason, for example, we recommend not to keep clean capital in UK bank accounts. There are certain rules which allow you to avoid inheritance tax in respect of non-sterling bank accounts owned by non-residents, but we'll not be considering this in detail. If you own a UK registered company, as I said before, unless the business property relief applies, if you die, such shares will be subject to inheritance tax. But there's a relatively simple way of avoiding such liability. You could own UK company's shares through a non-UK company, which is registered outside the UK, and immediately it will be considered excluded property. It's very hard to do any sort of planning in respect of UK's residential real estate, because no matter how many layers you put on top of your UK home, it will be always subject to UK inheritance tax if you die. However, if you're investing into non-residential property, then it is still possible to structure your ownership through a non-UK registered company and thus fully avoid inheritance tax liability.
Yeah, inheritance tax is a big thing. I think a lot of people from abroad may set up companies in the UK to do some trading activities or whatever, or investment activities, and not realize that they do have an inheritance tax exposure.
Indeed. What's also important is to understand that inheritance tax risk not only arises when a person dies, but also following making of a gift. There are many misconceptions about this rule, and I will try to summarize them. If you are living in the UK, and if you inherit an asset which is located outside the UK, and the person who died is not domiciled in the UK, typically it will be a situation when a foreigner comes here and they inherit a home in their home country from their parents. who have never set foot in the UK. The heir located in the UK will not pay inheritance tax. Similarly, if in my example, your foreign parents gift you a foreign asset and you receive it here, there's no inheritance tax risk for your parents. But if you own an asset in the UK, say you want to gift a UK property to your children, or if you want to gift a large sum of money kept in your UK bank account, if you die, all the gifts made within 7 years of death are included in the calculation of your inheritance tax liability. Therefore, it is very important to remember this. And if you're making a gift of UK property, either provide for your risks for the next 7 years or take the asset outside the UK. If you want to gift an expensive painting, physically take it out of the UK, transfer it abroad, and the recipient can bring it back here. If you want to gift a large sum of money in the UK, first take it out from the UK, say to a Swiss bank account, gift it there, and let the recipient bring it in the UK. However, as I said before, of course, you physically cannot do it in respect of UK residential property. For this, you should consider things such as insurance, or perhaps just hoping that you do not die within 7 years of making the gift.
Yeah, something that a lot of people don't know is that there are double tax treaties for inheritance tax purposes. Everybody knows that there's double tax treaties for income and capital gains tax purposes, but inheritance tax double tax treaties or estate duty double tax treaties, there are not that many of them, but the UK does have quite a few of them, and that will determine that a person who's resident in another country may not pay UK inheritance tax depending upon the terms of the treaty. We won't go into that so much, but talking about double tax treaties and in fact double tax relief, what happens with remittance of foreign income and gains when there's already been tax paid on those foreign income and gains in the local country?
The purpose of a double tax treaty is to avoid double taxation of the same amount of income. So say if you are a resident in the UK and you are paid dividends from Switzerland, if you pay Swiss withholding tax at 35%, and if you pay UK income tax at 45% on the same amount of dividends, you will only pay 10% difference, which is above what you would pay in Switzerland. However, the double tax treaties are not made to ensure double non-avoidance of tax. I will explain what I mean here. If you are not domiciled in the UK and you are using remittance basis of tax, you, as long as you don't bring your foreign income in the UK, you're not paying tax on it. So there could be an occasion where you would not pay any tax in the UK on foreign unremitted income, and you would also obtain a benefit under the double tax treaty, which would reduce withholding tax overseas or prevent you from double taxation. Most double tax treaties which have been concluded with the UK now don't give any benefits to people who are claiming non-domiciled taxation. The best example I can give is the US-UK double taxation treaty. If a person is UK tax resident and they're receiving dividends from US sources, you reduce US withholding tax, which is normally charged at 30%. You reduce it, say, to 5 or to 10%, and you pay the difference in tax in the UK. However, if you are claiming non-domiciled taxation, if you're electing to be taxed on remittance basis, you will not be able to benefit from the reduction of such rate. In other words, if you are living in the UK and you're receiving dividends or interest from the US, you will pay full 30% amount in the US, and you also will not be able to bring it here. This is a problem this problem arises when a bank gives you a W-8 form, which is a person claiming remittance basis of tax. Typically, you cannot sign.
I mean, you mentioned the US. The US, like a lot of countries, has an exit tax for individuals leaving the country. I know we're talking about people coming to the UK, but people might be interested in or have a concern, what happens when they leave the UK? They've built up a substantial company, let's say, whilst they've been here for 7 years, and then they leave the UK. We don't have an exit tax in the UK. As I say, the US and a lot of European countries do. I think it would be fair if we did have an exit tax, if we allowed people when they came to the UK to step up the basis of their assets to what they were worth, if you like, when they come to the UK, and only tax the difference. In other words, it would only be fair for the UK to tax the period in which the individual is resident in the UK and not on his gains beforehand. So what would your advice be in that respect, especially if there was a likelihood that we might bring in an exit tax at some stage?
Let's break up this answer in two parts. Step up in basis when you're coming to the UK and exit tax when you are leaving. Malta, Canada, I think a few other countries allow you to bring up the base cost of your assets to the current market value when you become resident there. The UK does not allow it. If you bought foreign property in 2010, if you become tax resident in the UK in 2024, and then you sell your foreign property in 2025, and then of course you bring your proceeds in the UK, you will be taxed on the difference on the increase of the value of the property between 2010 and 2020. What did I say?
2025.
2025. In other words, you have to use your historical base cost to calculate your gain. And this is a question which I'm very often asked by reference to property bought way before you come here and shares bought before you come here. However, of course, when the person stops being UK resident, there's no exit tax here. Strictly speaking, there are a few quasi-exit tax provisions, such as, for example, there's a clawback of holdover relief. This is when someone gifts you an asset and they hold over the gain. Then if you leave within 6 years of receiving the gift of the UK, then you have to pay tax on gain. Also, if you were trading in the UK as a sole trader or as an entrepreneur, by becoming non-UK tax resident, you must pay capital gains tax in respect of your trade. But these are very niche scenarios. If you're a typical investor who comes here, lives here, and then becomes non-UK resident, there's no exit tax per se to speak of. All you have to do is just notify the revenue that you're leaving, you pay your final dues of your taxes, and you're completely free to go. But there's an unexpected consequence of becoming non-UK tax resident. You see, if you are a director of a foreign company, and if you come to the UK, and if you are managing and controlling your foreign company from the UK, there's a risk of bringing tax residents of your foreign company in the UK and having to register it as a UK taxpayer. It works in the opposite way. If you were a director of a UK company and then you cease to be UK tax resident, then all of a sudden the revenue might say, you're no longer managing and controlling your UK company from the UK, you're doing it from the overseas, which means that you are effectively changing residence of your UK company. You're trying to attempt its re-domiciliation or tax migration. And the company may be considered going through the deemed liquidation and paying tax on the increase in value of its assets. I must stress, though, that it's not really the loss of your tax residence that triggers such deemed liquidation and potential corporate migration. It is rather the physical fact of no longer centrally managing and controlling your UK company from the UK. However, of course, if you're physically no longer present here, if you're no longer tax resident, the revenue might assume that you're no longer managing and controlling the company from the UK. So what would I recommend doing? Well, if you are a director of a UK company and you're physically living in the UK, either make sure that you're coming here to manage and control it, or appoint a local UK director, or just come to terms with the fact that you should just shut this company and pay your dues.
Okay, thank you very much for that. And back to the remittance basis, perhaps you could just mention the procedure for filing tax returns, and particularly you worked out you mentioned that if you are having to pay 30,000 a year after 7 years, you should calculate the tax that you would save if you actually paid tax on the entirety of your foreign income and gains, as opposed to the 30% level. Can you swap? You 1 year you claim the remittance basis, the next year you don't claim, and the third year you do claim the remittance basis of the taxation?
Yes, the way it works is the following. By virtue of having foreign domicile, you are allowed to use the privilege of being taxed on remittance basis. Now, every year, you simply choose whether you exercise such privilege or not. Every year, when you're filing your tax returns, you choose to tick a box whether you want to be taxed on remittance basis or not. Now, you don't need to decide on it during the tax year. You can wait until the end. Then you can look back and decide whether it was worth claiming remittance basis in respect of the year which has just ended. Practically speaking, in the first 7 tax year of UK residence, it's normally always worth electing to be taxed on remittance basis. However, Roy, as you've just said, when you have to pay £30,000 per year to be able to use such privilege, you may have to think twice whether it's worth claiming it or not. And indeed, it is possible to group your receipts in 1 tax year, pay 30,000 once, then wait for a couple of years, be taxed on a worldwide basis, or what we call it the arising basis, and then pay 30,000 again and not pay tax in the year that follows. Also, you can do it retrospectively. I think you can go back as far as 4 years to elect to be taxed on remittance basis or not. Just one thing that I want to stress is that when we are considering taxation of foreign income, we must not forget that it's not just direct income that we receive from companies, from your employment, that may be subject to tax. It's also, let me call it, imputed income that you have to consider. If you own a company which receives certain kinds of income or capital gains, even if you're not receiving any distributions from the company, you must nevertheless include in your return such undistributed income. And for this reason, it might be risky not to claim the remittance basis in the intermediate period, which I've just described.
And I'm sure you've come across many instances where wealthy people are still abroad. They're not coming to the UK, but their wives and children come to the UK. And I guess their wives might be completely oblivious to the requirement to file returns because they haven't had any income themselves, but they probably had something, obviously, otherwise they wouldn't be able to live here. So how stringent are the HMRC checks there, and what would your advice be to these wives and children who are resident in the UK?
To start with, if a person does not have any income or capital gains in the UK or overseas, they do not have to register as a taxpayer, and they do not have to file tax return. Of course, there are circumstances where a person may not know that they have foreign income, such as, for example, a child may be given shares by their father or some property, which and they may receive income from the overseas. There are certain exemptions which allow you to claim remittance basis, what we call, without filing a tax return. But in reality, the rules are very narrowly applied, and it's always best to act preemptively and file the tax return just in case. But as I said before, if you are receiving no income, then you do not need to file a tax return. Now, in a typical scenario, a family which lives in the UK receives gifts from their typically father, who is not UK resident and who is sending them money every other month or so. Gifts do not need to be reported to the UK. And as a result, you do not need to file a tax return if you're living only off the gifts. Now, a situation may arise that you are living in the UK just off the gifts, not filing any tax returns, but the revenue may ask a question. If you're not filing any returns, you're not declaring any income, how can you afford living here? To be honest, it's a bit of an unrealistic scenario, because if you're not declaring anything, it means that a priori you are not registered as a taxpayer, and they have very few means of knowing how you're living here. But in a more realistic example, a wife may receive small amounts of income from her UK investments, but the majority of her financing might come as gifts from her husband, which she does not have to report. Now she is known to the revenue. Now they know that she is reporting a very small amount of income, but living off amounts which is significantly larger than what she's declaring. And in this case, they might send you an inquiry letter. Typically, it says something along the lines of, we have noticed that you're declaring £10,000 of income. Explain to us how you're financing your life expenses. And then you must give them complete disclosure of how you're paying your bills, how you're paying for your accommodation, whether you brought any money in the UK. If you have brought such money in the UK, why you have not paid tax on it. You must show extracts from foreign bank accounts from which such money has come, and explain the nature of all the incomings into these accounts and why they're not subject to tax. So there's an argument in favor of not declaring your gifts, but rather making what we call a white space disclosure. A white space disclosure is literally a writing in a white space in your tax return, where you are letting the revenue know that you are receiving X £1,000 of gifts and you're living off them. This typically limits the inquiry window and fast forwards any inquiries that you may face from them.
Very good. Well, thank you very much. We've actually exceeded our 3/4 of an hour that we allotted to a webinar, because it's such a fascinating topic. I don't know whether you have anything last minute to add to what you've said, because you've been very erudite and very clear on loads of things. It can be a minefield. Residents, to some extent, has been helped with the statutory residence test, that we actually can compute whether somebody really is resident or not. That's helpful. But the remittance basis and what you're terming remitted income or gains is obviously quite confusing at times. Have you got anything to add before we wrap this up, Dmitry?
I think one last thing I want to say is the typical mistake that I see people making is underestimating how complex the UK tax system is. Many people say that I spent fewer than 6 months in the UK and I'm not a tax resident. Also, they're mistaken about when the tax year begins, and they start living here and they don't have enough clean capital. So if there's only 2 things or 3 things you remember from today's lecture, they should be the following. First, if you're looking to spend more than 91 midnights in the UK per tax year, which runs from 6th of April till 5th of April, you must check your residence. And the second mistake which many people are making is that they have their own companies which are located abroad. As far as they are concerned, such companies, they own their own assets, their own money, and they think that anything that such companies own, it's theirs. That's not true. A company is a separate entity, and unless and until such company pays you your dividends or salary, it is not your money. So a typical scenario would be a person coming to the UK and then thinking that they already have clean capital in their company, paying themselves a distribution. Of course, such payment will be considered their new income and not clean capital, and thus subject to tax.
Well, thank you very much, Dmitry. That's been fascinating. I'd like to invite you back again when the Conservatives, either the Conservatives or the Labour Party, abolish the non-domicile rules and introduce new rules on residence and remittances and things like that. We'll have to wait a little bit for that. But thank you very much. It's been a fascinating webinar, and I look forward to seeing you again soon. Thank you.
Thank you very much, Roy. Goodbye.